If you're someone who's saved $2 million or more for retirement, or you're on track to do that, there's a risk that could completely derail your plan. And many traditional retirement strategies don't actually plan for it very well. I'm not talking about inflation, taxes, or even average market returns. I'm talking about what happens when the worst years of retirement in the market show up right after you retire. Because at that moment, you're no longer contributing to retirement. You're forced to take income. And if you're forced to pull money from a down market, that can permanently damage your portfolio. Building to retirement is not the same as getting through retirement. I'm Justin Gartman, here from Better Wealth, a wealth coach here, and we're going to look at today. What I want to show you is what that actually looks like using real historical data. We've looked at it using hypotheticals, Monte Carlos, but we're going to look at the real historical data today and how adding something simple like cash value life insurance can protect your retirement plan in the red, but also give you more spending power in the green, because most people, well, you don't want to give that up either. You want to protect the downside while not throwing away all of the upside that you can get. But before we actually look at the numbers, I just want to make sure we're thinking about this in the right way, because the concept driving everything we're talking about is something most people don't fully understand. It's called sequence of returns risk. And all that really means is this: two people can have the exact same average return over 30 years while they're taking out income and end up in a completely different place from one another, simply because of the order of which those returns actually show up. So if you're still working, bad year in the market is not a big deal. You're contributing, you're buying at lower prices, time is on your side. But once you retire, everything flips. Now you're taking income. And if the market is down when you need that income, you're selling more shares at lower prices. And those shares are gone. They don't come back when the market recovers, because you already used them to fund your lifestyle, buy whatever it was that you needed there. And that's the risk. And there's actually been a lot of research done on this. One of the names you might come across is Dr. Wade Pfau. He spent his entire career studying retirement income. And one of the big takeaways from his work is that building wealth and living off of wealth are two completely different problems. If you want to treat them the same, you can run into trouble. So instead of keeping this theoretical, now let's actually look at an example. Let me introduce you to two couples that we're going to be following today. So first, meet Jack and Linda. They retire in 1973 at age 60, and they've saved right at $2.1 million. Their goal is to take $130,000 per year of income in their first year of retirement. And that number is actually going to increase by 2% every year to keep up with inflation. That's the plan. Then meet David and Sarah. Same age, same $2.1 million, but they're going to retire in 1995. So two couples, but two very different market environments waiting for them once they get into retirement. So in one scenario, all $2.1 million is going to be in the market in each of those years. And then the other $600,000 is going to actually be repositioned into permanent life insurance in the cash value. And that leaves the remaining 1.5 fully invested in equities. So you may be thinking, well, where did that $600,000 number come from? Well, simply put, that's going to be right about 4.5 years of income, because if we get too much into the life insurance, we have so many years of income there, well, we're going to give up a lot of the upside. But if we don't have enough, well, that's what we'll look at when we don't really have any, well, we don't have the buffer at all. And that's where things start to fall apart. So pull up the spreadsheet here and walk through what actually happened. So first, we have retiring Jack and Linda, years 1973, and they have everything in the market. And if you know financial history, if you've looked at historical returns, just looking at the S&P 500, it dropped nearly 15% in 1973, then dropped another 26% in 1974. So that's back-to-back loss of roughly 38% in the first 2 years of retirement, which is really one of the worst things that can happen once you get into retirement there. So now, here's what that actually looks like on a spreadsheet when we actually are pulling the income. You see that it would actually go down here. And so we have early recovery. If we put a comparison chart side by side, is that we retire here. You see, you start off up high with the market assets, have a lot more money, and you see a big drop in those first years there. So we have a significant drop going down there. Over here, we have, yes, it still dropped. We started off with less in there, but you notice that line does not go down as far. We didn't have as significant of a drop there because we also didn't have to pull income from the market. We were taking income in that year from the cash value if we have a buffer there. And so you can see how that plays out. After a few drops, the line with the buffer, actually now we're pulling ahead there. And eventually, yes, this runs out all the way at about year 32 there. And so you see how that significantly increases what we're looking at there. So traditional portfolio there, 1 year, Jack and Linda need that $130,000. That portfolio is down. So they're withdrawing from a shrinking base. Then they need, as it goes up, roughly $147,000 because they're also going to have to pay taxes on that, most likely. Now, you could say, hey, what if they had everything in a Roth? But we're assuming just a 10% here effective tax rate. So that's what we're looking at there. And so we have to pull out more than that to get the income that is spendable. So when the market drops, now they're selling those shares at a very steep discount, and those shares are gone permanently. We don't have the opportunity for that to recover. They're gone forever, and the portfolio just can't get a chance to breathe and bounce back. Now, by the time the market eventually recovers, the ongoing withdrawals have already gone down too much and taken too much damage. And you can see from that line graph we looked at, the money runs out well before year 30 here. You can look at the comparison here and see that the volatility buffer, we'd be able to last 32 years. So retire at 60. That's able to make it to 92 at that same income. Otherwise, we only make it to year 23 and we run out of money too early if we live past that. So that's sequence of returns risk in its most painful form. So now once that change happens here, we look over here, we shift over $600,000 into whole life insurance, and the asset that doesn't move with the market drops. We don't actually have to pull from the portfolio value at all. Same thing happens again in 1974. So we get past, like we said, sequence of returns early on in retirement. That's where the biggest risk is. But if we don't have to pull from there, we give it a chance. Yes, it bounces down, but then it has a chance to recover because we pulled from elsewhere there and has 2 years to sit undisturbed. And so allows that compounding to get back to work there. And so you can see clearly here, we're able to increase that by 9 years, same couple, same money, same income, but 9 years additional financial security. Only difference was having a volatility buffer there, a place that we could pull income from when the market was down. And this is exactly what the research says, exactly what Dr. Fowles' research describes when he talks about buffer assets. The idea is that after market dips, you pull from your income from a volatility buffer, minimize those losses, give the account time to recover, therefore extending the life of the investment account by years. And also, here's something we haven't even counted yet. If this is life insurance, there is going to be a death benefit. So Jack happens to pass away at any point during retirement. Well, Linda receives a death benefit that isn't reflected anywhere here in these numbers. So that additional capital, of course, would strengthen that dramatically and improve that outcome there. Now, before we bounce over to the 1995 scenario, so we're just going to change one thing here. I want to address something because I know what some of you are thinking. Okay, that makes sense for a bad market. But what happens if we actually did need that? Market's good. Am I giving up all of that growth by holding $600,000 outside of the market? And this is, I'll say, the most common pushback here is, and it's a fair question. So I want to look at the actual numbers, answer honestly here, that the assumption most people make is that life insurance buffer asset means you're just sacrificing all of that market return. Now, which in a sense, you are giving up the upside. So there's definitely some give and take here, and you're missing out on $600,000 worth of gross. But that assumption misses something very important, because when you use life insurance as the buffer, you don't have to reduce your equity exposure at all. You're using the life insurance as the reduction in that equity exposure. And if you think about traditional alternative to that, you have bonds, maybe money market, you have conservative allocation. Those assets also are not going to capture 25% of market returns or all of the upside there. The difference is whole life cash value is also going to be consistently growing, guaranteed to grow, just a matter of how fast with those dividends. You get the death benefit, and you have that access during that time. You can borrow from it realistically, even pay it back if the market does extremely well, refill that there, and carries that death benefit there. So Dr. Fowles' research frames the whole life insurance, even annuities, as providing an actuarial bond. So an environment that replaces traditional bonds or the typical asset allocation, dividing those functions of growth and income into separate assets, which can actually give you over time more growth and more income simultaneously. Because here we're looking at all equities and we're getting all the upside. Pretty much no one would actually have all equities as you get to retirement, or I would hope not, because that's going to have significant risk there. So we're comparing it to what would otherwise be your conservative allocation, and that's the right comparison. So let's look at what actually happened here. If I change this 1 year to 1995, and you'll see here now what happened. Called it David and Sarah. They retired, same $2.1 million, same $130,000, and adjusted for inflations. And 1995 is one of the probably best years to retire, to begin retirement. You have S&P going 37% up in that year, then 23% up, then 33% up, then nearly 29% after that. So you get 5 consecutive years of extraordinary returns. And if you're pulling income during that stretch, well, portfolio is growing by so much that those withdrawals are not going to hardly put a dent in that there. And so portfolio grows substantially, taking out income, balance keeps climbing. Now, of course, we hit some very bad negative years, 3 years in a row there, but by the time you get there after having 5 straight really good years, then it doesn't affect it nearly as much. And you will always have some down years in retirement. In this case, you also get to the 2008s, but we should always expect that. Important thing is when they happen. If they don't happen as early, it's not nearly as dangerous. If they happen later, then we've hopefully had enough time for that to continue to build up. And I'll say looking back is extremely easy to plan. Looking forward, it's a whole other story because we don't know when those returns are going to happen. We don't know the sequence of returns. Therefore, that's where the sequence of returns risk comes into play. So this plan still works in this scenario. Those 5 strong years create enough cushion. But what happens to the balance in later years, of course, now it's going to start coming down because we do have some of those bad years. And that's where pulling from the buffer allows those other assets to continue to grow up. Now, at the end of this, you do end up quite a bit higher because we had great returns there and there. And now, but that's also not factoring in that death benefit. So you're going to have that death benefit, which helps boost that balance up because maybe we didn't even need to touch the cash value at all there. So here's where be completely transparent here. In 1995 scenario, the ending balance with life insurance is of course going to be slightly lower. So I think we all understand that. Want to make sure that that is understood. So David and Sarah still have enough money at age 90. The plan still works. Ending number is just a little lower because we didn't actually get the big growth because we had some money allocated somewhere else. So again, though, probably going to have money allocated somewhere else anyways. And it allows you to, even if you had those good years, then you're hit with 5 straight years of bad years, you're going to have a place to pull money from there. So yes, you are giving up some of the upside, but you're protecting the downside there. So now during also, you get 2008, all that, they did not have to sell off assets. We could have already had that from cash value life insurance. Also no shifting to a conservative 60-40 allocation to manage the risk because again, to be honest, no one would be in all equities throughout retirement there. So buffer asset gives you the luxury to sell equities when you choose rather than being forced to sell for living expenses. And that's the real value. And in a good year, that discipline staying fully in equities throughout has its own compounding effect that partially offsets the drag of that cash value of not having that high of growth there. And again, have the death benefit. It didn't show here, but that's going to be a key factor of if you're looking at life insurance, death benefit is going to be something important to you there. So projection we're already looking at here is understanding what the actual outcome would be. Choice scenario, hey, 1995 is not insurance versus no insurance. It's do you want to slightly reduce your best case ceiling in exchange for a completely eliminating or very close to eliminating the worst case floor while staying 100% invested in equities and carrying that death benefit throughout. So for a lot of people, when we look at it that way, it's not a hard decision. It makes a lot of sense. So what does that actually tell us now? So whole life insurance is a retirement buffer asset. It's not going to be a magic solution. It's not going to transform a poorly saved retirement into a comfortable one. And it's not going to be the right answer for every situation. What it does and what the real historical numbers show is 2 specific things. In a bad sequence of returns, it can be the difference between a plan that works and one that doesn't. And in a good sequence, it can help you stay invested, avoid emotional decisions, and still be able to reach your goals. And if you think about it, that's really what we're after, right? We're not after the highest possible number on paper, but we're after a plan that works across a wide range of outcomes because retirement isn't just about growth. It's about making sure your income is there no matter what the market is doing. And again, retirement, it is a different problem than building wealth. The mistakes are harder to recover from. The tools you use should reflect that, right? And the goal here isn't to find the strategy, like we said, the highest ending balance is to find that works across whatever range of scenarios there. So that's what the numbers show. Again, every situation is going to be different. How much should you allocate? Whether this actually even makes sense for you. And all of those questions depend on those specific numbers there. And so if you want help actually walking through that together, you can schedule a call with me or someone else here at Better Wealth. And you can click the link here below or in the description, and we can help you determine if this strategy would improve your current retirement plan. And if you want to go deeper on this topic before talking with us, there's going to be lots of other videos that you can see here that I would encourage you to watch and learn more, even look at other examples of how you can apply this in your situation there. Thanks so much for watching, and we'll see you in the next video.